Now we are starting with capital market theory by Sharp. Okay, last lecture we covered MPT theory. Now we are covering capital market theory by Sharp. Okay, so what is the difference between both these theories? In Markowitz theory, you will calculate what Markowitz said is that we should invest amount in shares in we should invest amount in more than one security to get diversification benefit on the basis of correlation between securities was MPT theory. Okay, here what does Sharp say is that the same thing, the first line is same, but on the basis of beta of securities. So okay, he takes beta of securities into consideration. We can get diversification benefit on the basis of beta of securities. Okay, so what does Sharp say is that we can get diversification benefit on the basis of beta of securities. That is, beta means, what is beta? Beta is the risk of security. Okay, that is how much does the security move in comparison with the market. Okay, that is beta. Okay, we'll learn about this in later parts of this chapter, but we'll see what is the next topic in Sharp theory. Okay, the first topic is capital asset pricing method or CAPM. Okay, so this you have already learned in security valuation chapter. Okay, we will just brush through the topic. Okay, so what it is? It is used to calculate required rate of return. Okay, keep this in mind. We will calculate required rate of return. Okay, it is also known as expected return or equilibrium return. What does Sharp say? That is that your required rate and expected rate is equal. Okay, he doesn't differentiate between both of them. In Markowitz, what happened? Your required rate and your expected rate will be different. What is your expected rate in Markowitz? You analyze past data. Okay, you divide it by n. Okay, and then what happens is that after you get the value, you get expected return, and your actual return will be different. Okay, but here what does Sharp say is that your required rate and your expected rate will be equal. Okay, so it is also known as equilibrium return also. Okay, next, the required rate of return on security. How to calculate it? It is risk-free security plus risk premium on security. What is the risk premium on security? It is your beta RM minus RF. Okay, what is the risk-free rate of return? It is RF. If RM minus, what is RM minus RF? RM minus RF is your risk premium in the market. Okay, beta of security we take here. Okay, we take beta of security. Okay, because beta of market is 1, we don't need that. We need how much is the beta of security. Okay, how much does the security move with respect to market. Okay, and RS is your required rate of return on security. Okay, next we have some notes here. Risk free rate of return, that is RF. Risk free rate means those securities in which you get return without any risk. Okay, so what are those securities? It is treasury bills, that is your T-bills, treasury bonds, government securities, etc. Okay, they have zero risk. Okay, but in some question, if they have given beta, that means you have to take. Okay, there is some kind of risk. But if there is no beta given in question, we will assume it as 0. Okay, risk-free rate is generally given in question, otherwise it can be calculated as follows. Okay, how can you calculate risk-free return? It is your coupon payment on treasury bills divided by market or trading price of treasury bills. Okay, so how do you calculate risk-free rate of return? It is the yield you get. Okay, yield how you get? Coupon rate divided by market price of the treasury bond or government security into 100 we do. Okay, if 2 or more risk-free rate of returns are given in question, then as per moderate approach, we have to average out the risk-free rate of return. So what it is saying that, let's suppose there are 2 rates given. Okay, 5.5 and 5.5 and 5.25. Okay, there are two rates given. Now what happens is that if you take aggressive approach, you will take the higher rate, that is the 5.5. If you take conservative approach, we will take 5.25. Okay, we have to take moderate approach. So what do? We just average it out. Okay, 5.5 plus 5.5 plus 5.25 divided by 2. Okay, we take 5.375. Okay, this is known as moderate approach. We average it out. Okay, next, market rate of return. What is market rate of return? Market rate of return is that rate at which market means Sensex, that is your BSE's index, your top 30 companies, and Nifty 50 and index. Okay, these are known as your market. Okay, your stock market. Okay, now Nifty points is almost 26,000, your Sensex point is 74,000. Okay, these are what? These are market figures. This is your market return. So how you will calculate market return, we will see further. Okay, so market rate of return, how do you calculate it? If it is given in question, well and good. If it is not given in question, then we will calculate it like this. Okay, so index value, let's suppose we take 2025 data. At the beginning of the year, it was we'll take Nifty 50. Okay, we'll take Nifty 50 index. Okay, at the beginning of the year, it was 24,000. Okay, at the end of the year, the points shot up to 25,000. Okay, so how do we calculate it? We take the difference, okay, divided by the beginning value. This is basic. Okay, next, but do you think that this is right? Because you don't get only your difference in price, you also get another component called as dividend. Okay, in earlier Markowitz you learned D1 plus P1 minus P0 divided by P0, right? So that D1, so how do we get in this? Since in market you only have market price of securities. Okay, since in market you have just market price of securities, so how do you take dividend? If you take dividend is what? Dividend is based on your your face value. Okay, in market, since it is market value is since in market value is given, so what we need to do is we need to take dividend yield and not just dividend. Okay, so what is dividend yield? Dividend yield is your dividend per share divided by market per share. That is, how much dividend are you getting for your for the amount you pay in market. Okay, that is a dividend yield. Okay, so that also you will take into consideration. Okay, so divided by the index value at the beginning of the year. It is very much basic. Okay, but it is given in formula here so that you can if you don't understand the logic, you can follow the formula. Anyways, I have explained you the logic behind it, so you can follow the logic also. Okay, if market related data is not given, okay, if Nifty Sensex is not given in question, but data related to our portfolio is given. Okay, so what we assume is that our portfolio is the entire market. Okay, but in portfolio, if you see, we can, if you have an account in any of the brokers, okay, let's assume your depository participant is your Grow, your broker is your Grow app. Okay, in that you have securities. Okay, your holdings, right? Will you just have equity shares holding? Yes, most of you all will have equity shares holding, but in that same market, your bonds are also listed. Okay, bonds are also listed. So bonds is your risk-free market, risk-free securities. Okay, so we will take what? We will take all securities in the market, including our risk-free rate of risk-free securities. Okay, that is your end of the year. What is the total market value? Okay, minus your initial cost plus your total dividend or interest received during the year. Okay, of all securities in the portfolio divided by the initial cost. Okay, this will be your market return. Next, if in question we have a specific question here, question number 24, I'll relate to you there. Okay, if I'll just read it out, if you understand, well and good. If you don't, we have question number 24, I'll explain it to you there also. If RM and RF is required to be calculated in question and data is available only of expected return, that is the required return, and beta of two securities. Okay, then make two CAPM equations for both securities using the available data and then solve these equations mathematically to arrive at RM and RF. Okay, so in question, if you see in an equation, how can you find a data? If there is one missing figure, you can find. If there are two missing figures, you will make an equation. Okay, so two figures missing. So what you need in a question? You need RS, that is your required rate, RF, beta and RM. Four data should be there, but only two data is given. That is your that is your required rate of return, RS, and beta of security. Then also you can find both the data by using equation. Okay, that equation part I will tell you when the question arises. Okay, next, inflation premium is given. If inflation premium is given in question, then add such inflation premium in CAPM equation to arrive at required rate of return. Already discussed a question on this in security valuation chapter. In security valuation chapter, what we do, we add this inflation premium to a required rate of return. Okay, because inflation is increasing, our required rate also will increase. Okay, so we'll add to a required rate of return only. Okay, it's the same concept, that is your growth concept. Okay, inflation is we'll assume it as constant and we'll add it forever. Okay, so that's your concept. Next, if inflation premium is given in question, see, if you see in this one, I told you that KE minus G you have always assumed, right? That is your return will be growing continuously. Okay, but here what happens is that your inflation will be reducing every year, right? So that's why we minus it. Okay, so that's why we plus it. If inflation premium is given in question, then add such inflation premium in CAPM equation. Okay, this we learned. Okay, next, required rate of return on portfolio. What is required rate of return on portfolio? Just simply required rate of return of portfolio is equal to required risk-free rate plus your beta of portfolio calculated and RM minus RF. Okay, very much simply you can calculate it. But what is beta of portfolio? Beta of portfolio is nothing but your weighted average of beta portfolio. Okay, it is your weighted average of all the portfolio in the given securities. Okay, that is beta of A into weight of A plus beta of B into weight of B and beta of N into weight of N. Okay, like that we can calculate beta of portfolio. Okay, but in some questions of ICI, they have asked simple average of beta. Okay, this is not the correct method. Okay, weighted average is proper, but in some question ICI takes simple average of portfolio, of beta portfolio. In that case, what we do, beta of security 1, 2, 3 and 4, beta of security A, beta of security B, beta of security C, okay, divide by 3. Okay, we do simple average. Next, if required rate of return on portfolio is needed to calculate any item as balancing figure in CAPM equation, then required rate of portfolio is calculated as follows. Okay, so what they are asking is, if you have to calculate required rate of return on portfolio, okay, so how do we do? Required rate of return is how much your market value at the end of the year, market value at the beginning of the year, plus your dividend or interest, whatever you got in that, divided by your initial value of securities. Okay, in our portfolio. So this is your required rate. Okay, how do you calculate return? That's what, like your RM. Okay, you will take RP also. Next, decision making on the basis of CAPM. Okay, how do you make how do you make a decision on the basis of CAPM? There are two things. Okay, so how do you value? Okay, we evaluate the stocks based on it is overvalued, undervalued, or correctly valued. Okay, so decision to investor regarding whether he should liquidate his holding in stocks or make fresh investments in them. Okay, so these are the all requirements which would have been asked in question. If any of this question you see in exam, you have to calculate what you have to give decision. Okay, that is overvalued, undervalued, or correctly valued. So the first one is decision regarding whether you should liquidate all his holdings in stocks and make fresh investments in them. This is one type. And next, strategy or observation on stocks. Okay, whether portfolio has outperformed or underperformed, or whether company should change composition of his portfolio. Okay, any of this is asked in question. What you have to do? We have to give decision based on. We have to evaluate the stocks. Okay. Now, how you will evaluate the stocks? Okay. So, what we do is we compare the required return on stocks as per CAPM with the expected return on stocks as per MPT. Okay. Now, required return as per CAPM. What is CAPM? Your RF plus beta into RM minus RF is your CAPM, right? So that is your required rate of return. So expected return is as per MPT. Okay, your Markowitz portfolio theory or modern portfolio theory is your MPT. So expected return, if it is given in question, well and good. If it is not given in question, then take it as per MPT and then we have to evaluate. Okay, so what is expected return? Expected return is the return which you can expect in the market, which is probable in the market. Okay, what is required rate? Required rate is what we need. What is we need? Okay, so if we need more and expected return is less, so it is overvalued, so we will not invest in the share or we will sell the share. Okay, that is required return is more and expected return is less, we will sell the share. If required return is more, what we need is more, what we require is more, and but we are getting more in the market. Sorry, what we require is less and what we are getting in the market is more. That is, the share is undervalued, so we will buy the share. If required return is equal to expected return, when it is equally valued, so what is the thing in it? You need some return and you are getting that return, so you buy the share or you hold it. Okay, it's your call. We'll move on to the next topic, that is your beta. Okay, beta represents that how many times stock returns will fluctuate to changes in the market returns. As I told you, that how will your return change with respect to market change. Okay, that is beta. Okay, beta of market is always 1. Okay, your beta of security can be 1.5, 1.25, okay, whatever it may be, or 0.8, 0.7, whatever it may be, but your market return will be 1. Okay, so hamesha your beta of security you have to calculate in CAPM, okay, and not beta of market. Beta is calculated only for security and not market, because beta of market is always 1. For example, if A limited shares has beta of 1.2 and market return falls by 5%, then it means that return of A will also fall by 5% into 1 by 2. Okay, that is 6%. Okay, so this is what happens. That is, when your market falls by 1%, your beta falls by 1.2%. So your return falls by 1.2%. If your market increases by 5%, your beta will increase by 5% in 1.2, 5% into 1.2 into 6. Okay. Hence, beta is also known as sensitivity of returns of stock with respect to market. Okay, it indicates what? It indicates sensitivity. How much one factor changes to another factor. Okay. Risk of stock relative to market. Next, calculation of beta of securities. There are two methods. Okay, how do you calculate beta of securities? Okay, the first one is, if 2-period data of returns is given, of both security and market is given, then we take this. Okay, there are 2-period data. Okay, there are 2 years data. So what we do, we take security change in securities return divided by change in market return. Okay, so what is change in security return? It is end return of security minus return to of security. Okay, so simply what we do is, we take end of the year, so that is second year's data minus first year's data divided by second year's market data minus second year's first year's market data. Okay, we take the difference in between them. Okay, so how do we calculate this ratio? Why is security above? Because on the basis of what we are taking, we take it in the denominator. Okay, on the basis of what we are taking, we take it in the denominator. Okay, so how much is security changing in respect to market, right? So market will be down. Okay, in the denominator. Method 2, if multiple periods of data is given in question of both security and market. Okay, so how we calculate it? So what we do, we take covariance of security and market. Okay, we take covariance of security and market, we divide it by variance of market. Okay, so how we do covariance of security and market divided by security of market. If you further derive this formula, so how is it? What is covariance of security and market? This covariance formula you have learnt in security valuation chapter. What is covariance of, let's suppose A and B. Okay, covariance of A and B. What it is? Your standard deviation of A into standard deviation of B. Okay, into your correlation between A and B. Okay, that is what your covariance is, right? So here also same logic. Covariance of, that is a standard deviation of A, standard deviation of B, standard deviation of security, standard deviation of market into correlation between security and market divided by your variance of market. Okay, we can further if we open it up, then security of market, it is coming 2 times. Okay, we can cancel one of time. Okay, so what we get? RSM into security of market divided by market, or else security, standard deviation of security, standard deviation of market into correlation between security and market. Okay, if you understood this formula, well and good, or else just mug it up. Okay, so beta of security is equal to correlation between security and market into standard deviation of S, standard deviation of market. Okay, beta calculated from all the above methods will be same only. Okay, now there are some notes given in this, we will see that also. Okay, beta is calculated in numerical value, that is minus 1.5, minus 0.75, 1.2, whatever. Okay, it is calculated in numerical value. If beta is positive, it means that the security moves with the market. If beta is negative, that is the security has inverse relation with the market, it moves against the market. That is, whenever the security goes up, the market comes down. Whenever the market goes up, the security comes down. Okay, that is negative relation. Okay, so that's what is given here. Next, beta of portfolio is the weighted average of beta of each security in the portfolio. Okay, this also we have seen already. From the above formulas, we can calculate beta of equity shares of listed company only. Okay, how do you calculate beta? What is beta? Beta is how much your security changes with respect to the market changes. Okay, so market is what securities are in the market? The listed securities only. Unlisted securities are not traded in the market. Hence, to calculate beta of equity shares of an unlisted company, we have to do the following procedure. Okay, so there are 4 steps here, but this you will not understand now. So what we need to do, we need to first understand this one, relationship between asset beta and equity beta. What is asset beta? Okay, asset beta is also known as your company specific beta, company specific risk. Okay, or your project overall beta, project beta, or your overall beta, or your unlevered beta, or your ungeared beta. So what is asset beta? It is your company specific risk. Okay, or asset beta is also indicated as the industry's risk. Okay, there are various industries in the market. Okay, pharmaceutical industry, telecom industry, your textile industry, oil and rig industry, okay, fruits industry. Okay, there are various industries in the market, electronics industry, and all have specific risk. Okay, and return in the market. Okay, if a sector is growing, it will have more beta. Okay, if a sector is stagnant or at the maturity stage, it will have less beta. Okay, so like that we can take this. For your general knowledge, if I tell you that your beta of market is inverse, has inverse relation with your beta of interest securities. Okay, because whenever the market falls down, whenever there is less return in the market, people move to interest. Whenever there is less interest, people move to market. There is inverse relation. Okay, this is just for a general knowledge and not for exam purpose. Okay, next, it represents the risk in the business which is in which the company is engaged. Okay, I told you that is the industry. Next, this risk will be borne by the investors in the company, that is your equity and debt. Okay, a company specific risk or a industry specific risk is borne by both, that is your equity and your debt. Okay, how we will see. Equity beta is also known as stock beta, levered beta, or geared beta. Okay, equity beta is has the following 3 names, that is your stock beta, levered beta, or geared beta. It represents the risk borne by the equity shareholders. Okay, equity shareholders have to bear risk in the business and also risk due to debt in the company. This I will explain with an example. Okay, so how? So let's take an example. You have 10,000 rupees profit. Okay, so now what happens is that you take this is your EBIT. Okay, earnings before interest and tax. Interest, let's suppose you have 3,000. Okay, now you get 7,000. Okay, and this minus your tax. Okay, tax, let's suppose it is 30% minus 30%. Okay, this is your 70%. So how much will it be? 4,900, right? This is your earnings after tax, or EAES. Okay, let's assume there is no preference shares. Okay, now what happens, this will be the, from this equity shares will get EPS, right? So now what is happening is that in a specific company, if a company has debt, okay, the company, the equity shareholders will have to bear the risk of leverage, financial leverage. Okay, the company will have to face the risk of financial leverage. Okay, the risk that the interest portion is taking, they are getting less return, right, due to the risk of interest. Okay, and also the risk in business and also risk in the debt. Okay, so this is one risk, this interest portion is one risk, that is your fixed nature of interest. And another risk, what is another risk? It is the risk of business. Okay, In business, if in totality, what happens, in totality the industry goes down, okay, this can also be interpreted as your risk in the market of what, market of specific industry, okay, this can also be interpreted like this, okay. So there are two risks, that is one of the market. If it is unlisted company, that is then we will take the risk in the entire business, okay. Let's suppose what is the risk in the business? Let's suppose there is a the entire telecom industry has fallen down, okay, then this telecom industry which is unlisted will also be affected, right, because it is engaged in the same business. Also it has to bear the risk of interest, okay, that is the financial leverage also, okay. There are two risks for equity shareholders, okay. So equity beta will always be greater or equals to the asset beta, okay. So equity beta will always be greater than asset beta. What is asset beta? Asset beta comprises of two parts, that is equity beta and debt beta. What is debt beta? Debt beta represents the risk borne by debt holders, okay. There is usually no risk, but let's suppose there is a risk. In question, if there is given, there is a risk, okay. So in silent situation, what we do, we assume debt beta as 0, but if it is a given question, we'll take that into account, okay. So what is asset beta? Asset beta is the weighted average of equity beta and debt beta of the company, okay. We take what? We take weighted average. Next, so what is the what will be the equation? So now what you do for weighted average, how you do, you take a return, okay, you take a return into the weighted average, that is your particular security divided by total security, right, plus this return into the particular security divided by total security, right. So here the same logic is being applied. So what is the formula here? The formula here is beta, asset beta is denoted by beta of BA, or whatever you want to give the name, okay. So let's take asset beta as BA and beta of equity is BE into now equity, okay, equity portion, okay, equity portion divided by, let's assume equity as E, okay. So equity minus debt, sorry, equity plus debt, okay, the total part, okay. Now when you think that debt, it's not taking full risk, right, there is some benefit in debt. What benefit you get? You get the benefit of tax, you get tax savings in debt. So what we take? We take 1 minus t, right, plus your beta of debt into your debt 1 minus t, whenever there is debt there is 1 minus t, okay, divided by equity plus debt 1 minus t, right. This is a basic common sense formula, okay. You already know the logic, so it will be very much easy for you, okay. We'll take respective debt into what is the beta for debt portion divided by the total part, and what is the equity portion for the equity part divided by the total part. That is the basic logic. It is very much easy, okay. Just to put it in formula, we have put it here, okay, or else you can remember it by logic. Next, if a company has more than one business, then its asset beta will be weighted average of asset beta of all businesses of the company, okay. There are multiple businesses in the company, so that is more than one business in the company. So what we do, asset beta of business 1 into beta of business 1, asset beta of business 2 into beta of business 2. What is asset beta? Asset beta is total of one business, okay. Total asset beta is total beta of one business. So we'll take beta asset of company as one business into another business. So for individual business, we need to do this one. Okay, the above formula we have to do, and we'll do the again this one. Okay, there are some examples given. We will not take examples right now. We will directly do questions. Okay, in questions only we will understand everything. Okay, if at all there is a need to revise the concepts, I will explain it. I will take up the concept again and explain it to you. Okay, so that's it for today. Bye bye.